monthly webinar. Today's topic is State of Impact Investing in Canada. We'll just give a few more seconds for everyone to get into the room, and we'll get started. My name is Stephen Au, CEO at Genus Capital Management, and I'll be co-hosting today's session with my partners and colleagues, Stephanie Tsui, Head of Foundations and Nonprofits, and Mike Thiessen, our Chief Sustainability Officer and co-CIO. Today, we'll be discussing the current state of impact investing in Canada. We'll first begin with a bit of going backwards and looking at how we got to this point, and then we'll move forward and take a look at the trends and what's in store for impact on the horizon. We'll definitely have time for questions, so be sure to put those in your chat, and we'll get to those at the near end of the program. It's always a great idea to connect. So what we're going to do is we're going to put up some links so that you can connect with Steph, Mike, and myself on social media. I encourage you to do so. Always love to connect with people and answer any questions you might have. A few housekeeping items before we jump in. For your best viewing experience, maximize your screen. And as I mentioned, if you have any questions at any time, feel free to put them into the chat. And we'll get to those questions near the end of the period. We will have, if you have any technical troubles, please let us know through the chat as well. We'll have teammates on hand, on standby to give you a hand if we can. One very simple solution we've tried is hopping on and off if you have technical difficulties with your video or your audio. Now, to begin, I'd like to start by extending our gratitude to the Indigenous peoples, specifically the Coast Salish, the Tsleil-Waututh, Squamish, and Musqueam, whose land we are honored to be presenting on today. We do this to reaffirm our commitment and responsibility in improving relationship between nations and improving our own understanding of local Indigenous people and their cultures. I believe understanding the past allows us to build a better future. As we acknowledge the history of these lands, we are also recognizing our responsibility to work towards reconciliation and to support Indigenous communities in the journey towards self-determination and empowerment. Let my acknowledgement serve as a reminder of our commitment towards allyship and solidarity with the Indigenous peoples. So maybe to kick us off, Mike, because for some of us in the room are new, there are very lot of different terms in this space, impact, ESG, sustainability, responsible investing. Can you start by clarifying where impact investment falls in this spectrum?
Yes, yeah, happy to do that, Steve. Impact investing has grown a lot in the last few years, and so have all the terms and labels and everything. So I agree, it's good to get everybody on the same page. So Graham, if you could bring up the shades of green slide, that'd be great. Perfect. So for some of you, this won't be new at all. It'll be kind of review, but we know that there's a lot of people in the virtual room today that are new to impact investing. So we'll go over some of these terms. So on the far left, we have regular investing, which everyone knows. You're just trying to maximize your return, minimize your overall risk. Next up, we have responsible investing. So this is actually becoming quite commonplace for a lot of large funds and pensions and asset owners. And so with responsible investing, you are still trying to maximize performance, minimize risk. But in order to do that, you're taking into account some environmental, social, governance risks, so ESG risks. So maybe you're analyzing an insurance company and you want to look at some environmental factors that could potentially affect this insurance company in the future. So you're still trying to maximize performance, but you're taking in all the risks when you're making your decision, not just kind of the traditional financial risks. Then next up, we have socially responsible investing. Some people call this ESG investing. Some people call this sustainable investing. There's many different terms for this type. And this is more where you're applying different negative screens. So you're deciding what you don't want to be investing in, and then you're investing in the rest. So maybe it's tobacco, maybe it's fossil fuels, maybe it's companies that have controversies with Indigenous communities. You're deciding you don't want to invest in those companies, you only invest in the rest. And then with the rest of the companies, you're trying to maximize your performance. And then the next set of types of investing are all in impact. Some people call it mission-based investing. And so impact investing is where you're striving to make an intentional, measurable impact while at the same time making a financial return. So here you're not just cutting out the bad things that you don't want to invest in, but you're choosing the good things that you really do want to invest in. So you're striving to make a difference rather than cutting out the negative impact. So instead of just cutting out tobacco, you're deciding to only invest in innovative healthcare companies. So you're choosing to just invest in the companies that are making a difference. So there's a few different categories of impact based on liquidity and based on risk parameters. So the first one that we look at is liquid impact. So here you're doing impact investing, but you're doing so in a way that you can get out of your investment quite quickly. So this could be in public equities, it could be liquid green bonds. The next would be illiquid impact. So this is private debt, private equity. So here your money might be locked up for 5, 10, 12 years, but you're still making impact. It's just not liquid. Next on the list is venture impact. So this is venture capital, but making an impact. And so here your money is typically locked up. There are things like startup risk as well with this, but in many cases, you do have the potential to make a lot of impact with a lot of these smaller companies that you're investing in. And then finally, there's philanthropic impact. And this is where you're actually giving up some return or taking on more risk in order to make the impact that you're striving for. There is a myth that all impact is philanthropic, and I definitely don't think that's the case, and I believe we'll get more into that later on in this discussion. But you can certainly get market rates of return, competitive returns, and make impact. But a lot of investors choose to go with philanthropic impact because maybe there's a specific type of impact that they're wanting to make, and maybe that's the only way that they can access that type of impact that they're wanting to make. So that's philanthropic impact. So this is the overall spectrum of sustainable styles, and I'm sure you'll hear a lot of these terms in the next hour.
Great, thanks, Mike. Now, there's been a lot of momentum and interest in impact investing over the last few years, but there's probably also at the same time a lot of headwind that's come our way. So where would you say right now, where are we at with impact investing in Canada?
Yeah, so in Canada, it's come a really long way. I first started getting interested in impact investing in 2008. Back then, there were maybe a few impact funds in Canada, very few. I had a hard time finding them coming out of school at that time. I found out about impact investing through funds that were in New York and funds that were in London at the time, and became interested in it. And so if you fast forward to now, there are a lot of funds in Canada. There's new ones coming out, basically every week, it seems like. Especially in private impact. So in the illiquid impact category, there's a lot of funds, and the venture impact category. So it's come a long way. And GIN, which is the Global Impact Investing Network, they estimate that it's well over 1.1 trillion in total assets under management focused on impact worldwide. And it's in the tens of billions for impact investing within Canada. And there's some research that says that impact investing is going to grow at the rate of about 15 to 20% per year for the next 5 to 10 years as it becomes more of an interest for individuals, and the education keeps spreading, and then also wealth transfer to next generations that are more interested in this as well. So there's a lot of growth, and I think a lot of this growth has come from a lot of new products and from a lot of the pioneers in impact investing. There's some big pioneers here in Canada, in the States, in Europe, that have really pushed things forward when there weren't a lot of impact investors, but these pioneers really wanted to start impact investing. So they paved the way for everybody else. And so that's created a lot of big progress. I think there's a lot more information on impact investing out there right now. A lot of data, especially around performance. There has been a lot of myths in the past, and a lot of these myths are being busted, which I think is great. And then for us doing more investing in public equities, there is a lot more data around impact investing, and so that really helps us. There are still headwinds, of course, in the States. We've all heard of the political backlash against ESG funds, impact funds, even companies that have ESG policies. That isn't the case in Canada, but there certainly is, there are other headwinds here. I think one of the big headwinds is that there isn't common definitions for a lot of these sustainable styles. So we went over these sustainable style definitions earlier, but I think a lot of people still aren't quite educated on what is responsible investing versus impact investing, and even fund managers will mix up these different terms, and that makes it tricky for investors trying to get into it. They might think they're getting into impact investing, but actually it's responsible investing. But we can talk more about that later. But that's certainly a headwind. I think another headwind is lack of track record in Canada. There are a few pioneering, venture impact funds in Canada that have longer track records, like renewal partners, renewal funds, and there's some other VC funds that have 3 to 5 year track records in Canada. But when it comes to public equities, there's not long track records. At Genus, we have the longest track record for a fossil-free impact fund in Canada, almost 10 years now. So that's one of the very few in Canada. But a lot of investors want to see these longer track records in order to get into it. And so I'd say that's one of the headwinds that we're facing right now.
Okay, thanks, Mike. And how about you, Steph? What kind of trends are you seeing?
Yeah, so one main factor that I would like to add to Mike's points is intergenerational wealth transfer. We believe it will be a key driver for substantial growth in impact investing in the years to come. One report from the Mars Center for Impact Investing, it showed that approximately 90% of high net worth Canadians, they are interested in impact investing. And also the report also showed that demographics in the wealthier, more experienced, younger and or female categories of investors, they have shown particularly significant interest in impact investing. And that is also quite consistent with what we have been seeing from our own clients. And also, like, as millennials and women, they build wealth, and also they influence household financial decisions. Impact investing is quite likely to continue its rapid growth trend in the past years. And one final note, it's for millennials as a group, it is not something to be overlooked. Based on data in the US, they are the future recipients of expected $30 trillion of intergenerational wealth transfer through inheritance from the baby boomer parents. And that is approximately 3/4 of the size of the entire US equity market. So we believe this will give a huge impetus for more adoption of impact investing in the mainstream.
Great. Now, one of the lingering concerns that I've heard over the years is that one has to give up performance to have impact. What do you think, Steph? Is that true?
So many research and data, they have looked into performance of impact investing, and the observation has been largely in contrary of having to give up performance for impact. From a return perspective, there are two types of impact investing. One is targeting risk-adjusted market rate of return, or even above market rate of return. The other type is targeting below market rate of return, or concessionary impact. You may hear that term. This is where investors are willing to give up some return in order to get a very high level of impact, or something very unique type of impact. And so what I'm trying to say is, as an investor, you have the choice. And having said that, most impact investors, they do demand risk-adjusted at market rate of return. And for example, according to a Global Impact Investing Network report published in 2023, they have shown that 74% of the impact investors, they do require risk-adjusted at market rate of return, and approximately 79% of these investors, they have indicated that the investments have met or exceeded their return expectation, which is quite favorable. So over to Canada, the return expectation is even more skewed towards above market rate of return, or at market rate of return. And for example, according to a report by the Responsible Investment Association published in 2023, it showed that 85% of the surveyed organizations, they do require at least at market rate of return. And over 90% of these impact investors, they have indicated that the investments have also met or exceeded their performance expectation. And to kind of round up the discussion, I would like to, also speaking from our own experience based on the High Impact Equity Fund, As Mike mentioned, it has been running since 2014, and this fund has shown that you can get both impact and market-like return. For example, can we pull up that slide on the performance? Yes. So over the last 5 years, the high impact equity fund has been able to outperform the benchmark MSCI World while having done it with lower risk as well.
Great. Well, thanks. I mean, it makes a lot of sense, having the values alignment piece along with performance expectations. That makes a lot of sense to me. Mike, you have anything to add to that?
I think Stephanie summed it up very well as for performance. I think another myth with impact investing is that it's higher risk. I think a lot of people, when they think of impact investing, they think of philanthropic investing or concessionary overall returns, as in you're taking on a lot of additional risk in order to make the impact. And I don't agree with that. I think that myth has been busted as well. If we look at impact investing, you can have impact investing along the entire range of risk. You can have everything from an impact GIC, which has very, very low risk, is guaranteed, all the way to impact, venture capital or others, private equity that might have very high risk in some cases. And that's the same with regular investing. You can have everything from GICs to higher risk investments with regular investing as well. So I don't think that you have to be taking on that additional risk. In some cases with impact investing, you actually can take on less risk and still get the performance. I think one case for that is in times of crisis. So we certainly think that for the overall climate crisis, impact investors are going to see less risk with the transition from our current economy to a low carbon economy. There's going to have to be a lot of changes that culturally we're going to have to encourage everybody to do. We're going to have to, governments are going to have to encourage people to become more low carbon, more energy efficient. And with that, a lot of companies, a lot of investments are going to be hurt by that, but then a lot of companies are going to benefit. So renewable energy companies will benefit from that. Energy efficiency companies will benefit from that. Green buildings will benefit from that. And so you see a lot of these types of investments in impact venture capital funds, private equity funds, private debt, public equity funds, including our public equity fund. And then there are standard measures of risk as well. So within public markets, usually when people say risk, they are meaning really volatility, and sometimes they're meaning beta or market risk. So for volatility, I think we might have a slide on that, Graham. So volatility is actually measured usually in standard deviation. So volatility just means how much does your portfolio swing over time. So is there big swings? Like, are you up 25% 1 year, down 25% 1 year, up 25%? That would be a very high volatility fund. Or is your fund up or down 5% per year? That would be lower volatility. And so we found from our experience in public equity impact investing that our public equity fund actually has lower volatility than the market, and actually has lower volatility, or is in the bottom quartile for volatility relative to its peers. So that would be the bar that's second from the left, so standard deviation. The blue dot is our public equity impact fund, and then the orange dot is MSCI World, so the benchmark. And then the overall box are the different quartiles of different peers, so different funds in North America. So the top box would be the most volatile funds, so that's a big portion of them. And then it'd be the second quartile, third quartile, and then fourth quartile, so the least volatile. And we've actually found that our impact fund is actually in the least volatile category relative to peers in North America. And then another measure of risk traditionally in public markets is beta, or also known as market risk. And that is the measure of how much your fund actually moves when the market moves. So if a fund moves a lot more than the market when the market moves, it has high beta. And if it moves less than the market when the market moves, then it has low beta. So say the market goes down 2%, does your fund then go down 3% on average, or does it go down 1%? And so if it has low beta, it would go down only the 1% rather than the 2%. And we've actually found with our public equity impact fund, our experience has been that it actually has much lower beta, so much lower market risk. So this is the bar on the left. Again, the blue dot is our public equity fund. Orange dot is MSCI World. And then the different boxes are the different quartiles of different funds in North America. And our fund is actually in the bottom quartile when it comes to overall market risk. So overall, this fund is able to get lower market risk, lower volatility, and at the same time, it's been able to outperform the market over the past 5 years. So I think that our experience with public markets shows that you don't have to be taking on more risk. And then our experience with investing in a lot of private market funds shows that you don't have to be taking on more risk as well.
Great. Thanks for that. And thank you both for setting the backdrop to this. We're going to pivot next to take a look at the different types of impact investing. But before we go, get there, we'll go back to the polls and to find out what area of impact investing you are most interested in. So we'll give a few minutes, not a few minutes, a few seconds for people to answer the poll and take a look at the results. Climate is leading the survey right now. I think it continues. Social equity is another area where people have a lot of high interest, I can see. Okay, well, we'll keep those answers coming in. Steph, maybe some of our viewers are kind of new or just have a limited understanding still of what's available. So maybe you can talk about the different types of impact investing.
Sure. So in terms of focus areas, there are mainly 3 types of impact. The first one is environmental impact. Examples include renewable energy, energy efficiency, carbon reduction, waste reduction, clean water, sustainable forestry, agricultural tech as well. And among these, usually what we have seen based on different reports, clean energy solutions, food and agriculture are the ones that usually receive the highest investment allocation. And there are indeed many private funds or projects out there that are focused on different types of environmental impact. But one example that we could relate from the public space would be Solaria. Graham, may you pull up that slide? Yeah. So Solaria, it's a leading solar energy company based in Spain, and it specializes in the generation and development of solar energy from the manufacturing of solar PV panels to management and development of solar plants. And currently, within our high impact equity fund, we have about 2.5 to 2.6% weight. And 90% of its revenue is contributing to SDG number 7, affordable and clean energy, and 13, climate action. And it also has a pretty good ESG rating, actually one of the top AAA ESG rating, and a pretty good financial ranking within our own stock selection models as well. So the second type of impact is social. So examples include, as we seen, affordable housing, healthcare, education, inclusive finance, gender equality, social equity, and decent work and economic growth. And among these areas, affordable housing is the hot topic, often receive the most amount of attention. Others include healthcare and infrastructure as well. And if we take an example from the public space, thank you. So Dexcom, it's a highly innovative company in healthcare. It develops cutting-edge glucose monitor for diabetic patients, which has helped greatly reduce the risk of hypoglycemia for these patients. And 100% of its revenue is contributing to UN SDG number 3, good health and well-being. And it has an ESG rating of A, and also a good financial ranking within our models. And apart from contributing to positively to good health and well-being through its revenue, its operations also strongly aligns with reduced inequalities, SDG number 10, and as 62% of its workforce is either racially or ethnically diverse. And then third type of impact is through engagement. And through engagement, investors can influence companies' policies, operations, and strategy to contribute to sustainability, whether it's social, environmental, or just better governance practices, with the goal to drive company to merge profit and impact together, ultimately leading to positive system-wide change. One example would be with Canadian banks in recent years. For example, Shareholder Association for Research and Education, they co-filed a shareholder proposal with Tsui Family Foundation in 2021 and 2022 at Scotiabank. Basically, the proposal called to Scotiabank to align the products and services to the fossil fuel sector to align with the goals of the Paris Agreement. What it really means is they want the bank to adopt policies to align with the goal to limit global temperature rise by the end of the century above pre-industrial levels to 2 degrees Celsius, or better still, 1.5 degrees Celsius. And with all these work in the end, Tsui and Share, they got positive commitment from Scotia to develop and also implement these tools to measure carbon risk in their lending portfolio, and also restrict lending exposure to thermal coal mining or coal power generation. So this is how it could be manifested. And to sum up, other than different types of impacts in terms of focus areas, impact investing, as Mike mentioned, it could also be categorized into private or public. Traditionally, most impact investments were only available in the private space, whether it's investments in very early stage company, VC or PE, etc. But in recent years, we have seen that impact investing in the public space have picked up a lot of momentum. And this has really helped democratize impact investing and make it available to a spectrum of investors, not just institutional, but also retail investors, rather than being just available to accredited investors in the past. And we have also seen one report by the Responsible Investment Association published in 2018, looking at the Canadian impact investment landscape. And it showed that there was 41% impact investment allocation to public equity. This is a very phenomenal number considering it's only 2018. So we are also mindful of, when interpreting these data, we have to exercise caution. But nevertheless, we do believe that the growth potential in impact investing, especially in the public space, it's undeniable.
Right. Now, Mike, maybe you can help me, dive into that 40% number that Steph just mentioned, because impact means a lot of different things to a lot of different people. So maybe you can just shed some of your insight on that.
Sure. Yeah. So when I first heard that 40% number, I was quite shocked. I heard that number at a sustainable investing event sometime last year where they presented the report. And I think the previous year or the previous couple of years have been in the high 20s for percentage of firms that are doing impact investing. The reason that I'm shocked is because we are very deep in impact investing and we don't see very many other firms doing impact investing, especially in public equities. There are a lot of firms that are doing private impact investing, but not a lot compared to the total number of firms that are in Canada. So if I was to estimate how many companies or how many firms are actually doing impact investing in Canada, I would guess it's under 10%, probably under 5% in Canada. And I think the difference between that 40% and the possible 10% is probably the definition of impact investing for a lot of people. So I think one factor is that still there's the education around impact investing isn't very widespread quite yet, even amongst financial firms. And so some financial firms will believe and market responsible investment funds as impact funds. So responsible funds that are trying to maximize performance and can take into account some ESG factors if they choose to, they'll label those as impact funds. So I think that's one reason why those numbers are much higher. So it's not really to do with the research. It's more to do with the respondents not knowing the definitions. I think another part of the difference is one piece of the definition. So impact investing is intentionally investing in measurable impact and making financial return. And one of the keys that I think a lot of people miss is the intentional piece. So if a firm invests in a green building because it's the best financial deal, does that make them impact investors? Even though they're not intentionally investing in it for impact, they're just trying to maximize return. Or in 2022, renewable energy companies, many of them went up 90, 100%, 120% in the public markets. And so it would have been very smart financially to hold those investments, and many more mainstream firms did hold renewable energy companies, but not for the intentional impact, but more for financial returns. And that's great that they're holding renewable energy companies. There's nothing wrong with that, but I think that we're missing the intentionality piece of it. So if we take out intentionality, then yes, probably 40% probably makes sense. But that brings us to something called impact washing that we've seen over the last few years. We used to see a lot of greenwashing. Now it's more impact washing. Impact washing is where you are marketing a fund that is a responsible fund, or maybe is a kind of a exclusionary fund, and you're marketing it as an impact fund. And oftentimes firms will do this in order to gain more assets because they know that it's a high demand area. A lot of people are looking for impact. Impact is a hot, keyword for a lot of these funds. So they're wanting to call something impact. And the regulators are starting to crack down on this. They've sent out some recommended definitions on what impact investing is. But right now, everything's just recommendations. But I think in the next few years, there'll probably be more crackdowns on this. Certainly in Europe, there's different categories of ESG and impact funds that you have to fall within. And I would imagine in Canada, we'll probably be there relatively soon as well. And then there'll be less impact washing. But for now, if you are looking at impact funds, you can look out for impact washing. I think one key way to look out for impact washing is basically looking at the portfolio that you're about to invest in, look through the names and see if there's any names in there that you would deem as negative impact companies. So if there's a company in there that is extremely carbon intensive and they don't have a business line that's very impactful, then that's probably not an impact fund. Also looking at the holdings and looking at each company and trying to decide if there could be a business line within these companies that could be impactful. Some companies might not seem like impact companies, but maybe 20%, maybe 30% of their business is coming from, an educational product or a technology in healthcare or something like that. And so it's important to look over the portfolio. At Genus, we measure impact with a tool that we've created called the Net Impact Score. And so this measures the positive impact that a company is making, the negative impact, and then gets an overall net impact score. And so when we're doing this, we measure positive impact by looking at the percentage of revenue that a company is making from a positive impact product. So this product has to be contributing towards a United Nations Sustainable Development Goal. Many of you know the United Nations Sustainable Development Goals, which are quite popular and common to use in the impact investing world. So these are 17 goals created by the UN. They vary from anything from healthcare to education to affordable clean energy, climate action. And so we're looking at revenue, looking at segments of a company's revenue, figuring out which are positively impacting the United Nations Sustainable Development Goals and which segments are negatively impacting the United Nations Sustainable Development Goals. And then we're putting the positive and negative impact together and getting an overall net impact score. And so for our high impact public equity fund, we strive to have over 50% positive impact, which means on average, a company within this fund needs to have over 50% of their revenue coming from high impact activities that are positive, contributing towards a UN Sustainable Development Goal. We make sure that we have no negative impact revenue within our portfolio. And then so our net impact score is very high. And so right now for our high impact equity fund, it's at 56%. And that's the highest out of public equity funds that we've seen. Certainly if you do want to check portfolios that you're looking at that may or may not be impact portfolios, and you want to check their net impact score, we would be happy to put it into our system, and it could quickly show you what the overall net impact score is. And you can see the index here. So the benchmark for this fund is MSCI World. And so this is the all developed stocks or all stocks across developed markets in the world. You can see that there's a positive impact of 12.7, negative impact of 10. So this is things like tobacco, gambling, highly carbon intensive companies. And then so the overall net impact is 2.6. So that's the benchmark that we're looking at. And you can see that our high impact equity fund is much higher than that. And that's what we're striving for within this fund, alongside making financial returns.
Great. I'll take this opportunity to remind our viewers to enter in any questions they may have in the chat, as we're going to probably get ahead towards questions and answers soon. But before we do that, a lot of people may be wondering what's next. And so my question to both of you is, what's exciting about impact investing in 2024 and beyond? For this one, let's go with Steph first, and then Mike.
Thank you, Steve. So for 2024, I am very excited about the learning, to learn more about different sectors for impact investments, new business models, new technologies that could be impactful. So a lot of learning for myself as well. And also, I'm very excited and very looking forward to working with different organizations and potential partners, clients, to help educate on impact investing and mobilize more capital to areas where it could be the most impactful.
Mike.
Sorry, on mute. Yeah, so I'm very optimistic and very excited about impact investing for this year. I think impact investing has come a long ways. There's been massive growth in impact investing. And the thing that I'm most excited about this year, as Stephanie talked about before, was the growth in impact investing beyond foundations, beyond institutions, and into portfolios of individuals and families. I think that impact investing needs to be spread across portfolios, not just concentrated in family offices and everything like that, even though that's great and they've been amazing pioneers of what's happening. But I think that it needs to spread. And so I see that happening this year, and we already see that at Genus with a lot of our individuals and families getting more into impact investing. I'm going to give one more thing because I'm really excited about it, but I think the innovation that we're seeing in impact investing right now is really exciting. We're seeing a lot more innovative impact products coming to Canada. You see some innovative products in Europe for a long time. We're starting to get more in Canada, which is really exciting to try and solve some big problems that we have and need solutions for. So that innovation I'm excited about. I'm excited for the innovation with data and information around impact investing. We've been pushing our data providers for years and years to give us certain types of data, and they haven't been able to because they don't have, they're not beyond the threshold of demand that they need in order to put some analysts on the hunt for certain types of data. So we're starting to get more data, which I'm excited for, and we can start possibly making even better impact decisions based on this data. And then some new innovative funds coming out. There's funds that are focusing on making impact, not just through investing in impactful companies, but making impact themselves through activism and trying to go into companies and change these companies, lower their carbon intensity, increase their labor standards, improve how they deal with the different communities. And I think that's exciting to see different models of impact and different innovation coming to Canada.
Yeah, that's great. I mean, I think put it all together, and I think, with the increased research and reach to other households, I think is the amplification of the impact that we can make collectively. And as there's more momentum, I think that's going to be really exciting. So now maybe we open up a Q&A session for a little bit, and we'll begin with one question from Ian. How do you identify greenwashing, especially? So So maybe that goes to Mike. How do you identify greenwashing?
Yes. So we went over identifying impact washing slightly in one of the questions before. Greenwashing is slightly different. So greenwashing is marketing that you're having a green product, but it's actually not as green as you're saying it is. You're just using it as marketing to gain assets, or many companies are doing this too. They're saying that their products are sustainable when really they're not that sustainable if you kind of look under the hood. And so in order to fight greenwashing or to avoid greenwashing, I think you first need to look at the actual portfolio that you're investing in. So not just look at the fund or all of the marketing materials around the fund that you're looking at, but ask for the holdings of that fund. So look at the holdings. And if you're focusing on climate and focusing on lowering carbon, you want to be looking at the carbon intensity of the fund and the carbon intensity of the individual holdings. So carbon intensity is the tons of carbon emissions per million in sales. So it's basically how carbon efficient is the company. So if you look in the portfolio and you see that there's a lot of high carbon intensive companies within that portfolio, then that's probably not a very green portfolio, unless it's a fund that is using activism to try and drive down the carbon emissions of these companies. But right now in Canada, there's only very few firms that are doing that, so it's unlikely that that's happening. And if your fund manager isn't able to give you the carbon intensity of the portfolio holdings, then it's probably not that green of a portfolio anyway. So that's what I would do if I was checking for greenwashing, if I was looking at a fund.
Awesome. Well, I mean, you mentioned our fund, and I think there's a couple questions in the chat that I'll put together, and it's specifically about our Genus High Impact Equity Fund. Maybe to begin with I'll combine two questions together. One of them is, how many Canadian stocks are there currently in the Genus High Impact Equity Fund? And along with that, a question from Anne, is there any chance of the Genus High Impact Fund being closed due to insufficient good companies to invest in?
Yeah, it's a good question. So the fund is quite concentrated, and we like it that way because we want to only invest in the top impact companies that have really good financial ratings. And so, as Anne is saying, there's not a lot of high impact companies out there that are also going to rank well when we look at the financial aspects. So we have about 35 companies in the portfolio, but a lot of these companies are mid cap or large cap. And our fund, in the grand scheme of things, is quite small right now. So right now our fund is about 100 million, and we could get much larger than that before we would hit any sort of threshold where it would be hard to take on larger positions in those same 35 companies. We wouldn't even need to expand beyond those companies because those companies are quite large, and this fund is relatively small in the grand scheme of things.
And a question from Sucheta. I've heard, she's heard that, or this person has heard that investing in companies that are currently high carbon but working towards becoming greener could possibly help climate change. Thoughts on that?
Yes, I have lots of thoughts on that. I think that's a really exciting area for impact. I think that there is an opportunity for investors to invest in high carbon intensive companies and really work hard to drive down the carbon intensity. I think, though, that it is difficult to assess the effectiveness of a manager doing that, though, because there are a lot of managers that will say they're doing engagement, and they are engaging, but are they actually making deep, long-lasting changes in these companies, or are they just, filing all their proxy votes? So there's a huge range when it comes to engagement. So I would ask a lot of questions if the manager was really focusing on engagement. I think that's a great thing to do. And at Genus, we do focus on engagement as well. So for our impact fund, we are intentionally investing in high impact companies that then will make the measurable impact. And then we're engaging these companies to be even better. So that's one way to do it. Or you can invest in the companies that are maybe more carbon intensive, or maybe there's social aspects that you don't like about that company, but you as the investor or the fund manager is going to make the difference. So that's harder to do, especially if you're a smaller fund, but you can make large impact that way.
Okay. And are our investments in Europe, Asia, or North America, or global, I guess?
So our investments are global for our public equity impact fund. We also do private impact investing as well. So we invest in a lot of venture capital funds, private equity funds, private debt, infrastructure, real estate, all on a customized basis for clients. And so talk to a Genus portfolio manager if that's something of interest to you. And so those are global as well. But we can focus on Canada for those private investments. We have a lot of clients that do want to be focusing just on Canada when it comes to their private investments. When it comes to public equities, it's much harder to focus on Canada. It may not be a surprise, but there's not a lot of high impact Canadian public companies. There are a few. There are some green real estate companies that we've invested in the past. We've invested in hydrogen companies in the past, but there's not a lot.
Okay. And Tom has asked, does Genus advise or participate directly in developing companies in venture impact category?
So we do not invest directly in venture. So we invest in venture funds that are experts in that field. So there's a variety of different venture funds that we invest in for our Impact Investment Council clients. So when clients come to us, they tell us what they're passionate about in terms of overall impact, and then we'll develop a private impact portfolio based on that area of impact that they're really passionate about. And so really these venture capital funds are the experts when it comes to startups. And so we don't pretend to be experts in that space. We partner with these other firms.
Okay, great. Alejandro asked, most of the funds in impact investment come from institutional investors or high net worth individuals. Do you see impact investing becoming more accessible to the general public in the future?
Steph, do you want to take that one?
Sure. Yeah, so that's kind of relate to, like the portion that I talked about earlier. Yes, we do see substantial growth potential in impact investing available to the general public. And just take the example of a high impact equity fund. You don't have to be an accredited investor in order to invest in it, because we already do all the diversification and suitability analysis within the fund. So you don't have to be basically a retail investors can also get access to it. And with more availability of these type of funds, then general public will have definitely will have more access to impact investing.
Great. Yeah, and I'll add to that. I mean, earlier I alluded to, my excitement about amplifying our impact, and part of our news is that our Genus High Impact Fund, we've created a prospectus around it, and we've launched it as a public offering. We believe that it's a solution that should be part of everyone's portfolio, as long as it's suitable for the investor. And we made that strides in that, in getting it onto other platforms, so that we could collaborate with other institutions and getting the impact type of investments accessible to the general public. And so, hopefully people here today are clients of Genus, but if not, definitely ask your advisor about our Genus High Impact Fund, and so that we can help serve you as well. One question we have here, and what advice do you have for aspiring impact investment analysts regarding professional experience, skills, and knowledge? I think we have an internship program, Mike. Maybe you can kind of talk about that.
Yes. So we've been, right now we've been interviewing a lot of interns, which has been really exciting. It's unbelievable to me how well-versed a lot of university students are in impact investing right now, which is amazing. In a lot of courses, they're learning about impact investing, sustainable investing, environmental practices for companies. So it's a huge change from back when I was in university, which is really exciting. So we are looking at interns right now. We've been hiring through the Propel program. They're a great organization that has been helping us get interns for the last few years, focused on impact. I think if I was person just getting into impact investing, I think I would want to do an internship. I think that would be probably the first thing I would want to do, is to learn as much as I can in a practical nature, and meet as many people as I can that are in the field, that are doing different things in impact. There's a lot of reading material around impact right now. There wasn't a long time ago. So I think between reading lots, internships, and networking, I think that's best route to go. I think you could probably give that answer for most fields that you're wanting to get into, but same goes for impact.
That's awesome. Thanks. I think we have time for one more. And this for Steph. How can I start this conversation with my financial advisor? I'm guessing that's about impact investing.
Sure. Number one, obviously, start the conversation with your advisor by telling them you want to look into, aligning your investments with your values, and tell them what you're passionate about. And is there any way you could merge your investments with the areas that you want to advance or promote, or the values that you hold dear? And ask them what options your financial advisor could offer. And it would be good if they say, yeah, we have option A, B, C. And if they do have some options, be sure to ask them questions, such as, just to make sure, the investment process, the selection process can actually help you align the investments to what you would like to advance. And also, secondly, if that's a yes, is ask for the track record, whether it's been running for a decent period of time, and the performance. And so that should kind of help start the conversation and continue your journey of impact investing.
Great, thank you. That's all the time we have for today. Some of the questions we didn't get to, and if you left your contact information, we'll be sure to have somebody reach out directly to you and try to answer those questions. For those of you still on, please stick around a few more seconds. You'll be redirected to a survey. Your feedback is very important, so that we can help improve and tailor our webinars to suit your needs. I want to thank all of you for taking your time out to be with us today. For those of you that are clients of Genus and are new to Genus, thank you for your time. I would like to thank the team for putting this together. These webinars take a lot of work, and I want to thank everybody who's involved. A recording of today's webinar will be provided on our website, so feel free to go back and revisit or share with family and friends. And I hope you enjoy the rest of the day. Thanks.
Thank you.
Thank you.